Picture the last time that you sat across from the financial advisor. They pulled up the screen. Stocks, bonds, a few mutual funds. Maybe an annuity if they were feeling generous. And every one of those options had one thing in common. You were the customer. You were the one handing over the money and hoping it'd grow. Here's what they never showed you. Every one of those projects has a other side. A side where you're not a customer, where you are the one that's getting paid. And the cleanest example of that is sitting inside something you already understand better than you think. A mortgage. So let me show you the side of the mortgage where your advisor will probably never bring up. Not because it's hidden, because they don't make money when you sit on that side. Quick word on who's talking, so that lands the way it should. I'm Mario. My wife Lorena and I run Ritual Notes. We've been in real estate since 2006. Started where most people start, in single family homes. Tenants, mortgages, the whole thing. I came at a finance background, so I always paid attention to the money underneath the deal, not just the property on top of it. And over the last 5 years, more and more of what we do has moved to the financing side, the loans, the notes. Because once you see how the money actually moves in real estate, it's hard to unsee it. The person who owns the building takes the calls. The person who owns the loan gets the payment. I've stood on both sides, and I want to walk you through the side that nobody put in front of me when I started. So here's the thing about a mortgage that most people never stop to think about. It has two sides. One side, there's a borrower, the homeowner. They got a house, and every month they send a payment. On the other side, there's the lender. Right now, that's the bank. The bank put up the money, and every month that payment lands in the bank's account, principal and interest. You spent your whole life being trained to be the one on the borrower side. Get the loan, make the payment. Or, this is the part that stings. You've been on the saver side, which is really just funding the bank side without getting the bank's returns. You put your money into a savings account at 0.5%. The bank turns that around and lends it out at 7%. You're financing the lender side of the deal. You're just not getting paid like the lender. Becoming a bank is simply moving to the other side of that transaction. Same real estate, same monthly payment, you just change and which seat are you sitting in. Let me make this real, because the other side sounds abstract until you see a number. A mortgage note is just the paperwork behind the home loan. The borrower is writing a promise to pay, secured by the property itself in a first lien position. That phrase, first lien, matters. It means if anything went sideways, the loan you own is first in line against that house. That's the structural backbone underneath all of this. Now picture a real one. There's a homeowner, let's say in Ohio, who's been paying their mortgage on time for years. The remaining balance, what's called the unpaid principal balance, is $80,000. They're a good payer, steady, boring in the best way. The bank that owns that loan doesn't always want to wait 20 years to collect the money. Banks sell those loans at the time. That's normal. Everyday thing in the mortgage world. So that notes come up for sale. And instead of the bank, you buy it. You pay $74,000 for it. That's about a 7.5% discount to the balance. And that's normal for a performing note as well. These don't trade at some wild markdowns. They trade at a tight band, usually around 5 to 9% off. The day that the sale closes, something quiet but kind of remarkable happens. You're the bank now. That homeowner's payment, the one that used to go to the bank, now comes to you. and every month. You don't buy the house. You'll never see the house if you don't want to drive by it. You own the loan tied to it. So what does $74,000 actually do for you? Taking the discount and the monthly payments together, a performing note like that tends to work out somewhere in the range of 8% a year. And I want to be careful here. That's an example, not a promise. And you should always run your own numbers with your own advisor. Where it gets interesting is that the return isn't one size fits all. It depends on how involved you want to be. And that's really the whole map of how someone gets into this. Some people just want to understand it first. Totally fair. That was brand new to me once. That's where you start, learning the mechanics properly before you ever touch a dollar. Some people get it, like it, but don't want another thing on their plate. They've got a career, a family, enough going on. For them, the move is to invest alongside us, passively. We handle the buying, the servicing, the management, and they hold a position backed by a first lien real estate without doing the day-to-day work. And then some people want the whole thing. They want to own the note outright and even self-manage it. And when you self-manage, you're not paying anyone else to service it. So that same kind of deal can stretch up towards 10%. More control, more upside, more of your own involvement. The same $74,000 note. 3 different ways to sit in the lender's seat, depending on how hands-on you want to be. Notice what's not on the list though? No tenants, no toilets, no 2 AM phone calls about a water heater that broke. The homeowner owns the house and all the headaches that comes with it. You own the payment. So why didn't advisors even mention any of this? Honestly, mostly because it's not on their product. They get paid to put you into the things on their shelf. A $74,000 note bought directly isn't on that shelf. It's not a knock on advisors. It's just the shape of the business. The bank doesn't advertise the lender's seat either. For the same reason, the house doesn't hand out the math. And none of this requires you to be wealthy or accredited. It used to. The side of the table was basically reserved for banks and institutions. That's the door we spent our days trying to open for regular people who just never knew it was there. So let me leave you with something simple. Your actual next step is not a pile of theory. If today was the first time that anyone laid out the 2 sides of a mortgage for you, the move isn't to go and buy your note tomorrow. The move is to learn how this works properly in plain language. And that's exactly what our 5-day Become the Bank challenge is for. 5 days, 1 short lesson and 1 small action each day. And by the end, you'll understand the thing that your advisor skipped, with no obligation on the other side of it. The link is right at the top of the description. From there, and the 3 doors that I mentioned are all open. Learn it, invest alongside us, or own it yourself. But it all starts with seeing clearly the other side. And before you go, I actually like to hear from you. Which seat have you been sitting in all these years? The borrower or the saver? Tell me in the comments. I read them and I answer. Let's talk about it.